This French stock is one to watch. Eurofins Scientific is a lab testing company that has been one of the best performing stocks in the world, but shares have fallen 50% over the past few years, giving investors a chance to buy the dip. At the latest price, Eurofins has a market cap of 10.2 billion euros. With 614 million of cash and 2.7 billion of debt, the enterprise value is 12.3 billion. Revenue over the last 12 months comes to 7 billion euros, with 400 million of net income, 1.4 billion of ebitda, and 865 million of free cash flow. So the stock is currently valued at 25 times earnings and 14 times free cash flow. That valuation is lower than the company's historical average. Eurofins provides lab testing services for food companies, pharmaceuticals, cosmetics and the environment, and the company has grown from just 3 employees 30 years ago to more than 60,000, rolling up almost 600 smaller businesses in the process. It's been a highly successful model. Profits have soared, and between 1997 and 2022, Eurofins shares increased over 36,000%. That's more than Microsoft and almost as much as Amazon. And Eurofins is also a highly resilient business. Companies are required to test their products to make sure they're safe, even during economic downturns, and Eurofins has built up a sizable advantage with its sprawling network of laboratories. The big question then is why the stock is down 50%. The first reason is COVID. Eurofins saw its profits surge during the pandemic as its testing services came into high demand. As the pandemic faded, profit margins have normalized. But the second reason is more troubling. In June of last year, short seller Muddy Waters released a report accusing Eurofins of governance failures and potentially inflated financials. Muddy Waters says that Eurofins is an opaque shell business operating over 1,000 legal entities with inconsistent auditors. The short seller also accused the Eurofins CEO of self-enrichment through M&A linked real estate deals. Eurofins did respond to the allegations, but the stock has remained roughly flat since the report. Looking at both sides, it's clear that Eurofins is a highly complex business. It's built on hundreds of acquisitions, and some weak controls may have crept in over time. The balance sheet has also become more bloated, although management does say it can dispose of assets if it needs to. On the other hand, Eurofins is still highly profitable and a large and important business. The company is now buying back stock, optimizing costs, and could do over €1 billion of free cash flow in a couple of years. That makes the valuation look attractive here despite the complexity. But these are my personal opinions, not financial advice, and I currently hold no position in Eurofins stock. For more investing ideas, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.